Do you own rental properties? If so, then you might have thought about holding these properties inside of a corporation. In today's video, I'm going to tell you why it might not necessarily be a good idea to do this and what you should be considering to do instead. Make sure you stay all the way to the end of this video if you want to learn about key tax mistakes that most real estate investors make that are costing them hundreds of thousands of dollars. Let's dive in. All right, guys, the first thing we want to talk about is triggering a taxable event. There are a number of reasons why you should not put a rental property inside of a corporation, such as an S-Corp. There are a number of key reasons why you should never put a rental property in an S-Corporation. The first of these reasons is because if you decide you would like to remove the property from the S-Corp at some point in the future, you're going to trigger a taxable event, meaning that you're going to owe taxes. Now, there could be a number of reasons why a person would want to remove their rental properties from their own corporation. For example, he or she might want to remove the property for asset protection reasons, estate planning, refinancing. Maybe you have to refinance the property in the name of yourself. Maybe you were the person who originally bought the property and then you transfer the property into an S-Corp and then you find out later that you have to refinance the property in your personal name. But regardless of the reason why a person wants to remove the property from the S-Corp, even if they just want to transfer the property to another entity that they own, it will still be considered a taxable event. The problem with making this maneuver is that it always leads to a tax bill. For example, let's say that you bought a rental property for $600,000 and that it appreciated to $1 million. If you sold that property at $1 million, you would have to pay a capital gains tax on the $400,000 capital gains that you made. Having to pay a massive capital gains tax bill wouldn't be so bad if you were actually selling the property to a third party, but if you're just moving assets around to restructure your portfolio, then this is the last thing that you want to deal with, aka a gigantic tax bill when you haven't even truly sold the asset. But unfortunately, many rental property owners are unaware that removing their properties from their S-Corps triggers a taxable event, and thus they get stuck having to foot a large tax bill. Guys, please do not let this happen to you. One of the things that I also want to make sure that I mention is that when you decide to place your rental property inside of an S-Corp, there's no step up in basis. Another important reason why you should consider avoiding putting rental properties in your S-Corp is because S-Corporation assets do not receive a step up in basis upon the death of the owner. If you're unfamiliar with the term step up in basis, it is when an asset is reassigned a value that is equal to the current fair market value of the asset if the owner dies. So what that means is, for example, is if an owner has an asset that's $1 million when they purchased it, but when they die, it's worth $2 million, then the owner who is getting that asset transferred over will have that asset valued at $2 million. And that is called the step up in basis. The purpose of step up in basis is to prevent beneficiaries from having to pay capital gains taxes on all of the appreciated value of the asset during the lifetime of the former owner. So if the former owner owned that asset at $1 million and then it appreciated to $2 million and then it was transferred to a beneficiary, the beneficiary can sell that asset for $2 million without experiencing capital gains taxes, hence the transfer of wealth. The fact that rental properties in S-Corporations cannot get step up in basis when they're passed on after the owner dies is probably one of the biggest downsides of putting these assets in an S-Corporation. So this is true if you plan on passing down these rental properties to your children or even other beneficiaries after you die, such as grandchildren. To understand how significant this is, let's say that you bought a rental property in 1990 for $1 million, and that property is now in 2023 worth $4 million at fair market value. So you've experienced about $3 million in unrealized gains. Typically, if you were to sell this asset, you would experience capital gains taxes on that $3 million. But if you have the step up in basis, when your children or your beneficiaries receive this property valued at $4 million, they can technically sell the property and experience $4 million completely tax-free. If you didn't put your rental property in an S-Corporation, and if this property could be stepped up in basis at the time of your death, then your beneficiaries would not have to worry about paying taxes on that $3 million capital gain. However, if you held this property in an S-Corporation, you would not get the step up in basis, and thus your beneficiaries would have to pay capital gains taxes on the $3 million due within 6 months of your death. So you can see how this is one of the ways in which the wealthy have built wealth over time. They understand this information. So if you do not want to saddle your beneficiaries with a massive capital gains tax bill, then you should strongly consider not putting your rental properties inside of an S corporation. Now, what are some of the other limitations that S corporations have? In addition to triggering taxable events every time you remove a rental property from your S-Corp and not being able to take the advantage of the step up in basis, there's also other limitations that the S-Corp may have as it pertains to you being a real estate investor. For example, S-Corps can only have one class of stock and a very limited number of shareholders. In fact, S-Corporation owners can only have 100 shareholders. So if you want to try to divide up the ownership of this real estate asset or take on investors inside of this S-Corporation, this ain't the vehicle for you. S-Corps are also very strict about who is allowed to be an owner. Only United States citizens, resident aliens, grantors, living trusts, estates, or nonprofit entities are allowed to actually be S-Corporation owners. Corporations, partnerships, business trusts, and IRAs cannot be S-Corporation owners. So there's a significant limitation here. Many people who want to share ownership of rental properties with various entities under their S-Corp have difficulty doing this because of these restrictions. So why do people put real estate in S corporations in the first place? Like, why do they even do this? A lot of people put rental properties in S corps because they think that they will save a lot of money in taxes and that everything will be easier because S corporations don't have self-employment taxes.
Easy peasy.
This does not make any sense because there's no self-employment tax on passive income. It makes sense for some people when they're thinking about it, but in the end, it never typically makes tax sense. S corps are pass-through entities. This means that they're not taxed at the corporate level, and instead, the tax is passed through to the owners. So in other words, S corporation owners do not have to deal with double taxation like C corporation owners. So essentially, a lot of people think that they will save money in the corporate and self-employment taxes if they place their rental real estate inside of an S corporation, and that the advantages of doing this will outweigh any of the disadvantages of doing this. But as you guys just saw, this is not the case. And I explained earlier in this video, there's some significant downsides to using an S corp for rental real estate. So what should you do instead of using an S corporation? We've talked about why it's not a good idea to put rental real estate in S corps. So you might be wondering, where should I be parking my real estate instead? The real answer to this question is that each person's situation is unique and each person should speak with a tax expert before you make a decision on which business structure to use for your rental property business. However, with that being said, there are some important advantages to using an LLC for your rental real estate business that you should be aware of. For example, with LLCs, you can transfer the property out of the LLC without realizing a capital gain and back into the LLC without realizing a capital gain. It's not considered a taxable event. For this reason, LLCs offer a much higher degree of flexibility compared to S-Corps when it comes to rental real estate. And like S-Corps, LLCs have liability protection and do not have double taxation that C-Corps have. However, unlike with S-Corps, rental properties inside of an LLC will get the step up in basis for shares owned by the descendant. This can help your beneficiaries potentially save tons of money in capital gains taxes, and you can pass off your rental properties after you die without worrying about whether or not they're going to receive that step up in basis based on current tax law. LLCs also are generally just easier to set up than S-Corps because there's just a little bit less reporting. And for this reason, many real estate investors just prefer to have these LLC structures in place, knowing that they can bring on outside investors. Another important advantage of LLCs is that they can have more than 100 shareholders. In fact, LLCs can have an unlimited amount of owners. So if you want to have more than 100 shareholders for your real estate investing business, then an LLC can be a much better choice for you. In addition to all of these benefits that the LLC has, S corporations have a little bit more maintenance. S-Corps must be managed by a board of directors and officers. Even if it's yourself, you have to be your own board of director or your own officer. And this makes the process of running them just a little bit more complicated than the LLC. LLCs do not have to have a board of directors. And in fact, with the LLC, the owners can manage the company themselves or just hire a manager to manage the business. Now, I get asked this question, should I have multiple LLCs for my rental properties? The great thing about LLCs is that they separate your personal assets from your business assets. So if you are sued and if your rental property is inside of an LLC, then your personal assets would be protected depending on the state in which you set up the LLC in. However, if you own multiple rental properties and if you're keeping them all in one LLC, then you could also be putting yourself at risk if you're ever sued. For example, let's say that you own 3 rental properties and that one of your tenants in property A is suing you due to a slip and fall incident. Instead of the income and assets associated with property A being at risk, now the income and assets associated with property B and C are at risk as well in the lawsuit. However, if you had separate LLCs for each of these properties, then only property A would be at risk if it's caught in a lawsuit, right? So yes, creating multiple LLCs and putting one rental property in each LLC would be a good idea for many people. The reason why most people don't do this is because of the cost associated with running multiple LLCs. Is something you have to look at. But it does make more sense to have separate LLCs for each property. If your properties are lower in value, then bundling 2 or 3 of them under the same LLC can be okay under certain circumstances. After all, if you have multiple LLCs, then you'll have to pay multiple LLC fees and associated other fees every year, which can lead to a couple $100 or a couple $1,000 each year. But if you want optimal security, like optimal security and protection from lawsuits, creditors, and if your properties are at least a couple of $100,000 in value each, then I would go through the process of creating separate LLCs. This is usually the better option for protection. The question I also get is, do I have to file a tax return for my LLCs? If you have a single member LLC, you'll report your income on Form 1040, Schedule C, or Schedule E if it's associated with your rental property. If you have multiple member LLCs, then you'll be required to file a Form 1065 to report your income and expenses inside of a separate entity, and then you'll have a K-1 form which passes through to your individual tax returns. This form gets distributed after your 1065 tax return for your multi-member LLC is filed. K-1s have to be filed with the IRS as well. So yes, you will still have to file some tax forms for your LLC every single year with the IRS. This might be a little bit of inconvenience to you, but this is a part of the nature of running a rental property business correctly. Now, because you have to file taxes for your LLC, it is critical that you keep accurate records of all of your income and your expenses. Please make sure that you're documenting your income and expenses for your rental property business, just like you would if you were running a McDonald's business. We need to know the amount of income and the amount of expenses coming out of that business bank account. If you do not want to do this yourself, you can always hire a tax professional or an accountant to assist you with the process. The more properties you have, the more complicated your tax returns will be. That's why it's beneficial to get a CPA or a tax professional involved early on. Many people want to understand what's the difference between, working with a tax professional, working with a CPA. I have CPAs in my office that are very good with the numbers. That's what they're really strong at. And then I have other enrolled agents and tax professionals who can assist you in leveraging the tax code, AKA doing tax planning. Now, are there any downsides to using an LLC for rental real estate? This might be something that you may not have thought about. As you can tell by now, there are a lot of advantages for using rental real estate. However, yes, there are a few downsides as well for using LLCs. For example, if you decide that you would like to carry out other real estate activities such as flipping real estate, then you most likely have to pay expensive self-employment taxes that are at 15.3%. Luckily, however, rental real estate income is not subject to self-employment tax because it's considered passive income. So you won't have to pay the 15.3% on this amount of income that's flowing through your LLC. This is very, very important to understand. If you're going into real estate investing, you're going to be earning passive income, which is not subject to Social Security and Medicare taxes. If you're going into real estate flipping, wholesaling, becoming a real estate agent or a broker, that is active income subject to self-employment tax, AKA why we look at S corporations. If the government required real estate investors to pay self-employment taxes for rental income, then profit margins would be far less and you would see far less real estate investing. So it is a great news that the government does not require self-employment tax for rental income. And in fact, this is one of the main tax advantages that draws many people to rental real estate for business purposes. Getting financing for rental properties is the tricky part, which is what prevents many people from going down the road of investing in real estate, saving up money to get into an investment property, having good credit, qualifying for a loan, affecting your debt to income ratio. That's the tricky part. But if you can solve that part and work with a really good lender that helps you leverage your business or helps you leverage your ordinary income to qualify for a loan, you can set yourself up to invest in real estate and run a real estate operation that can eventually outweigh your ordinary income. And that's what I seek for everybody. Now, choosing between an LLC and an S corporation is something that you have to understand. As I mentioned earlier, the exact right answer to this question will depend on what type of business that you're trying to run. I strongly recommend that you speak to a tax professional before making any decisions. However, with that being said, for most real estate investors, LLCs are going to be the better option. for most real estate developers, flippers, brokers, wholesalers, an S corporation is going to be the better option. LLCs provide so many benefits for real estate owners that they're even commonly used by advanced and famous real estate investors such as Donald Trump, such as Jeff Bezos, and many others. If you have an LLC for your rental real estate, you will be able to use step up in basis and you won't create a taxable event even if your properties are moved out of the LLCs and into new LLCs. You can do this. All of these advantages are compelling and they demonstrate why many real estate investors just choose to go with LLCs as opposed to S corporations. However, if you plan to use your real estate business to primarily flip properties, then we might want to look at the S corporation because S corps do minimize your self-employment tax burdens. So if a large portion of your real estate business will include active income with flipping or other related activities as opposed to passive rental income, then an S corporation could be the better option for you. What if you already have an S corporation? What should you do now? If you're already an S corp and you already have properties in the S corp, then you can still keep your S corp and enjoy pass-through taxation and liability protection. However, you need to be careful about taking properties out of the S corp because you will trigger a taxable event when you do this. You need to make sure that you speak with a tax professional to discuss what your options are. You might be better off waiting until you're actually ready to sell a property to ever remove it from the S corporation. If you do decide that you would like to invest in more rental properties, you should probably look at setting up a brand new LLC to do this. After all, just because you have an S corp doesn't mean that you can't set up a new LLC for new properties in order to take advantage of all the benefits that LLCs have to offer for real estate investing. Having one or multiple LLCs for your properties can give you much greater level of flexibility for your real estate investing business. And it can create additional tax deductions because you have multiple different entities. Here's what I want you to walk away from with this video. Number one, both S corporations and LLCs allow for liability protection and pass-through taxation. So you can avoid double taxation with each one of these entity structures, and you're reducing your vulnerability from lawsuits. Number two, LLCs are probably the better option for most real estate investors because they provide the step-up in basis for properties, and LLCs can help you avoid certain capital gains taxes because they are generally easier to manage. And number three, if you already have an S corporation, don't panic. They're still good business structures, and they are still useful for real estate investors. However, if you want to adjust your strategy and perhaps start using a different business structure, then it would be wise to schedule a complimentary consultation with my tax team. You need help figuring out which is better for your real estate investing situation, an LLC, an S corporation, then feel free to get in touch with my company today. We can help you create a custom tax strategy for your real estate investing business that allows for you to minimize your tax obligations while maximizing your tax savings. You can schedule a complimentary consultation with my team by clicking on the link in the description below this video. You can also find a link to my course, Tax Alchemy. In the description below, this course will teach you strategy used by the wealthy to save money on taxes every single year. We go over real estate investing not only for short-term rentals, but also for long-term rentals. So feel free to sign up for that as well. Okay, that's it for this video, guys. I hope that you enjoyed it, and I look forward to seeing you in the next one. Cheers.